Good afternoon, everybody. It is Sue here, and we have another wonderful, engaging training and development workshops for you to watch here on replay. And obviously for our people live in the room, it's great to see you all here. We have Tina Steele from Steele Aspire Financial Management here today. She is one of our impact members, and she is a fantastic Love Biz member. Have to say, she brings people nearly every month to our events. So we always appreciate Tina bringing guests. It's all part of Love Biz's ethos. It's making sure that people are speaking about us, bringing, referring. So it's great to have you all here. Now, this workshop's a little bit different to some of the others, but we've all got our notebooks ready. 3 elements of finance. Here we go. Let's make a start. Tina, would you like to welcome yourself and also share maybe briefly your past journey on where you are and why you are here today? Over to you, Tina. It's your show now.
Thank you very much. Hi, everybody. I'm Tina Steele, and as Sue said, my business is Steele Aspire Financial Management. I am a financial advisor, but my past career was an accountant. I'm still an accountant, but not practicing. But I didn't work in a practice, so I didn't do people's books as people think accountants do. I worked in industry, manufacturing first, doing budgets and forecasts and all those kind of things. And then I went into education and was head of finance director level at universities and colleges. So a bit of a different background, but I quickly found what I loved throughout all of my career was looking after my teams, the well-being side, the educational, seeing them grow in confidence as they learn things, and then looking after budget holders within departments, so training non-financial people on finance and using jargon and words they could understand rather than the technical things. So I've brought that into my financial advice business, and I think the two work perfectly together. So, okay, I'm going to share my screen. Hopefully you can see that. Brilliant. Okay. I think I can see most of you on the screen as well, but if anybody does have a question as we're going along, feel free to unmute yourselves because I might not see the chat box. Okay, so today we're going to do 3 elements of finance. So this is what I've built my business upon. So the 3, oh, I've already done an intro, I'll skip past that one. The 3 petals in my logo stand for financial well-being, financial education, and financial advice. And I think these 3 should always go hand in hand when anyone's looking at their finances. So the well-being aspect is putting you in control of your finances, which hopefully will give you that peace of mind, reduce anxiety that you might have. And this can be people who are struggling with money. It can be people with money. You know, it's all sorts of the spectrum. And I see clients that are very anxious about what to do with their finances and how to plan for that future. So that's the well-being aspect. And to get the well-being and put you in control, you need the educational bits. So you need to learn what your options are. You need to fully understand them so you can make those informed decisions. And that's when the advice comes in. So hopefully you need somebody to help you along the way, and having somebody that you can trust to educate you and improve your financial well-being. So we're going to touch on some elements today. Obviously, finance is a huge topic, but hopefully I'll throw some bits in there that'll be kind of hints and tips and make you think about things a little bit differently. So financial well-being, we're going to start with first. So I just want you to have a quick think about your key financial concerns coming into this session before. You might not have had any, you might have had some. So I'm just going to give you a minute just to jot any notes down that you want to about anything that's in your head that you want to get out and think about today. You don't have to share this. I'm conscious of the fact that finance is a very personal thing and not always everybody wants to share, but if you want to catch up afterwards as well, I'll give you those details at the end, but just for the session today, if you want to make a note. Feel free to share if you do want to, though. Everybody had the chance to jot something down? Yeah, great. So what we're going to think about now is short, medium and long-term goals. So you might have had some ideas about things that you're thinking of, you know, finance-wise, that it might be really, really long-term. It might be retirement you're thinking about. How am I going to get there? It might be really short. You know, how do I protect my income now? You know, there might be a whole variation. So what I kind of talk through is how to split those into short, medium and long term. So again, if you just want to jot down what's your short, medium and long-term goal, you might not have something in all the categories, but just have a little think about how you might split those things you've just talked about, or if there's any more that come up for you. And again, another question that sometimes people have asked in these sessions is, how long is short? How long is medium? Generally, I go with the 5, 10, 15 years. It's different for everybody. Your short term might be, what am I going to do this month or this year? So again, it's very individual to the person and what's important at that point, but kind of general rule of 5, 10, 15. Okay. Everybody had enough time? Yeah. Brilliant. So what we're going to go on to now is 3 personas, just to give you an idea of different traits and characteristics about financial mindset. So we have Safe Sophie, Carefree Caroline, and Savvy Sam. So I'm just going to talk through these 3 personas, and if you can listen and see if you resonate with any of them, whether you want to resonate with any of them, whether anything's coming up from you from your planning bits that we've just done. So first of all, we've got Safe Sophie. So Safe Sophie is generally risk averse and considered in her approach to life. She's much about planning for the future, but she does so in a very risk averse way. She saves mostly in cash. She's always been a saver. She has a high amount put away, but her money isn't necessarily increasing in value because her returns are being impacted by inflation. She's become more considered since taking 2 career breaks to have children. So what are Sophie's short, medium and long-term goals? In the short term is raising and protecting her family whilst managing household budgets and saving what she can for the future. A medium term are schooling costs, mortgage repayments, home improvements and a return to full-time work. And her long term is she'd like enough money to retire comfortably when she wants to, not necessarily at state pension age, and to ensure future generations of her family are looked after. So Sophie is in a comfortable position to achieve her short-term and medium-term goals, but she may be sacrificing some enjoyment because she's saving so hard. She also may need to think about her approach for the long term because of the inflation impacting her cash savings. Might not necessarily be in the right place. Okay, so that's Safe Sophie. Next, we have Carefree Caroline. She's the total opposite to Sophie. Caroline's been travelling, has no savings, no buffer for any unforeseen circumstances. She rents a house by herself, which she can only just afford as she's living a carefree lifestyle without too many responsibilities. Caroline doesn't have any investments, nor does she contribute anything extra to her pension. So what are Caroline's short, medium, long-term goals? Her short-term goal, she wants to continue to fund her lifestyle, aims to travel again soon, and she doesn't have any medium or long-term goals. Okay, so that's Caroline. Then finally, we have Savvy Sam. So Sam is considered in her approach to finances. She budgets and has developed a keen interest in the property market. She also realises she needs to diversify how she saves and invest to achieve the goals that she wants to have for the future. Her short, medium, and long-term goals. Her short-term goal is to make overpayments on a mortgage to pay it off to ensure she can afford a family when she decides to have one. And a medium-term goal is she aims to continue to add to diversify her portfolio of investments for retirement and make sure she has the relevant protections in place to make sure she could pay the bills should she fall ill. And in the long term, she hopes to retire from employment and pursue her interest in property to ensure that her and her partner have enough away for retirement as well as supporting the family. So Sam sits in a happy medium between short-term enjoyment and long-term benefits. Okay, so that was our 3 personas. So again, just thinking about what you wrote down as your short, medium and long term, do you resonate with any of those 3? Do you want to be that person or do you want to be one of the others? Is there anything you can do to think about changing that? Does anyone want to share? Again, you don't have to, I appreciate it's personal. Okay.
I'll share.
Thanks, Sue.
We could probably add an extra 0 and an extra half again on top of their ages for where I am at the moment.
Yeah, Yeah, and this is the short, medium, long term. It's different for different people.
Yeah.
I mean, you still can't achieve, you know, your aspirations by planning carefully. Yeah, absolutely. Thank you, Sue. Thank you for sharing. And I think the personas are very generalized. So, you know, you take elements from each, and sometimes it is, as you say, it seems overwhelming that you don't have the ability to do some of the planning, but actually sometimes a tiny little thing can make a big difference for the future. And I'd say it's never too late for planning. Absolutely. Okie dokie. Anybody else want to share any questions? Okay, so that was the well-being part. So it's thinking about what's occupying your thoughts, what have you not got control of, what do we need to have a look at to kind of fix that well-being aspect. So we move on to education. So knowing a little bit about what you can do can give you that well-being. So we're going to touch on budgeting, spending and saving first. Interestingly, kind of show of hands, does anybody budget? Do you know what's coming in and out? Couple? Yeah. Oh, most. Well done. Great. Rachel's just popped back on. Brilliant. So this is an example of what someone's monthly outgoings might be. So what I tend to do when I'm looking with clients at expenditure is I break it down between essential and discretionary. So your essential is those bills that you have to pay no matter what, to kind of live and get by, and then your discretionary is your holidays, entertainment, clothes, those kind of things. So breaking it down and having that budget to understand what you can and can't make a difference to is sometimes really useful. So there's an example on here. You've got home costs. So you've got your rent or mortgage, council tax, bills, utilities, mobile phones, TV license, etc. We've got transport. So if you have a car, or you know, you pay for trains, buses, etc., you know, you might need that to get to work or to get to clients. Other food, we all need to eat and drink, so you know that is an essential, and obviously the costs of everything are going up at the moment. So thinking about what those are, you might have pension contributions, etc., hobbies, gym, and then protection. So if you talk about protection, life insurance, critical illness, health insurance, etc., and then other costs. So you might have childcare, education, family costs. So that's just an example of how that might break down for somebody. So last little exercise, just to have a think about. So what I'm talking to people, I break down income, essential and discretionary. And then what we do at the bottom is get down to your disposable income, so what you have spare every month. And quite often when I do this exercise with people, we get to the bottom and it might say we've got £500 or £1,000 spare every month. And they go, no, I have about £10. You know, and quite often it's going back and looking at where that is spent, and is it essential, or could you be doing something a little bit different to get to those future goals that you want to get to? So if you would like to jot down now off the top of your head what these things might be, and we'll go through a few slides, and then after the session, if you want to, you could look back and find out on your bank statements or whatever, you know, online banking, what you're actually spending against what you think you are, and see how that differs. So see how in control you are of your finances. So the first one's income. So I know a lot of us are self-employed, or we are employed, but we are sole employees of our own businesses. So the income may be up and down. It may vary. So what I would suggest with this is looking at the last 12 months or the last tax return and taking an average of your monthly earnings. You may have other income, so you might have rental income from properties. So again, that might be set, but maybe there's some void periods if people are in and out. So again, take an average probably over the last 12 months. If you have any investment income, any dividends from shares, anything like that can go in there. Any maintenance payments you might have, pension, you're all too young for pension income, and any other income from anywhere, any other income stream. So some of us have more than one income stream coming in. So just have a quick 30 seconds to a minute, have a think about what your income is, if you know what it is. Okay, all okay with that? Brilliant. So this is essential expenditure. So this is what I say are the things you have to pay. So again, when we come to protection later on, these are the things that even if you were ill and unable to work, you didn't have income coming in, these still need paying. So this is your utility bills, gas, electric, water, council tax, broadband. You can see the big list there. So again, I'm going to leave that on the screen for a minute. You might not have time to jot it all down, but obviously you can see the replay afterwards, or I can send you the sheets if you want it. But just having control, like, do you know what these costs are costing you every month? Rachel nodding. Okay, lots of nods, that's good. And you might not have all of these, and you might have some more that you think are essentials that I don't have on the list as well. And interestingly enough, when I was saying sometimes go back after the session and look at your bank statements, quite a lot of people I've talked to have found direct debits and subscription fees I didn't even know they were paying. So actually it's a really good exercise to clean up and find out what you are paying for and think, gosh, I didn't know that was on there. I didn't list it, so I'm clearly not using it. Had enough time on that one? Yeah. Okay, so the next little bit, I put this as a separate section. I class this as essential, but some people don't. So I thought I'd put it in the middle. So this is an insurance protection. So again, there's lots of different types you can have: life insurance, critical illness, you've got your home and car insurance, medical insurance, and other. Interestingly, I've put the life and critical above the home and car. Most people insure their homes and cars, don't necessarily insure themselves. And if you're not okay, and if you're not here or not well enough to work, then that's the income stops coming in. So actually it's really, really important to look at protecting yourself as well, and we'll talk about the options of that later on. But again, just jot those down if you know what they are. And similarly to the subscriptions and things you might not know you're paying, a lot of people have an insurance policy from years ago and don't know what they're covered for. Okay. And then the final bit is discretionary expenditure. So this is the nice to haves. So I've got some general categories here. Again, you might have different things that you put down, but entertainments are going out, meals out, trips out, theatre, that kind of thing. Do we know what we spend on average a month? Might go up and down. Holidays. Do you have a set amount that you put away for holidays each year? Any savings? Do you put away regularly, or is it as and when, or if you can? Subscriptions, as I mentioned, there might be some subscriptions you class as essential. I've put them down here in discretionary for now. Sky, Netflix, that kind of thing. Clothes, interesting one. Kind of buy as and when, or do you have a set amount? House maintenance, not everybody always puts things in there. You might not want to, but obviously that emergency fund, will come on to that in a minute. Sometimes if things break, but some people put in a regular amount to kind of put away in case anything happens. This one's a little bit trickier than the top one because they're not set amounts usually. So when you've had a chance to do all of that, at the bottom is the disposable income. So you take your income, minus off your essential, minus off your insurance, minus off your discretionary, and at the bottom should be roughly what you've got left in the bank account each month. So when you do that exercise, and like I say, if you look back, be interesting to know whether that is what you've got roughly left every month, or where is it disappearing to. So it's quite often there is a category in there which I didn't mention, which is spending money. Kind of cash in your pocket, going to get your Costas and Subways and whatever else it might be, nipping out for a coffee. They quite often add up, and that's sometimes where the money goes. Any questions on any of that? Any thoughts? Is that useful?
I have a thought and sort of a question, but you touched on money, Tina, and cash. And I think when you go to the cash point, which for me is quite rare these days, but I always do have some cash. When you go and take £20 out of the cash point machine, you then think a few days later, where did that £20 go? Because there's nothing left. Whereas, and I think cash sometimes is easier to spend and disappear rather than maybe buying something with your card. And I know there's a lot of people who don't like the idea of us not having cash anymore, but I find it that I buy small amounts without sort of wasting away that extra, that bit of change and that fiver and things. So that's just my own thought. Don't know whether anyone else thinks like that about cash. It just disappears too quickly.
I do. I am absolutely the same thing. I use my card for pretty much everything where I can. I've got a record and, you know, can trace that back.
Yeah, and that's good, isn't it, to have that record? And when you're doing something like this, it really helps you to work out how much you actually spent on the going out and the coffees and things, doesn't it?
It does. And sometimes it's a bit of a, I don't know, it depends on your mindset. And this is where we go back to the well-being. Is this a comfortable thing to do? Is it easy to look at where you're spending your money? You know, some people are in denial that I'm fine, but actually, if you want to get to those future goals, can you change anything that's not going to make that much difference to your life to make it better for the future?
Yeah, it was really interesting actually, because I've just been changing all my bank accounts, and like Tina said about those direct debits and those monthly payments, and you think, gosh, I can't, you know, you can't recall sometimes it coming out your account, and do you actually need it? And I actually cancelled a lot of things when I was changing the bank accounts, because I went off and found better value, like pet insurance and things, because it made me think about what I was spending, because it just was coming out every month, and saved quite a bit of money when I reviewed things like certain insurances and things like that. Thank you, Tina. I'll shut up now.
No, it's great. Thank you. Okay. So saving what you can. And like I say, some people can't save. And you know, they're not in a position to save, but if you can, or you can think differently about some of those expenditures, can you afford to save a little bit? And I think the way I like to look at saving is that you spend what you can after saving, not save what you can after spending. So actually build it in as an expense if it's possible.
Thank you.
No problem. So yes, there's lots of things going on in life, you know, holidays and trips out and all sorts of things. So it's getting that balance. So you don't want to fully save every penny you've got and then have a miserable life and not do anything. So it's that balance to getting right, and it will be different for absolutely everybody. But a cash reserve is needed. So that emergency funds that I mentioned before, those unforeseen circumstances. So the systems advice say that it's always good to have 3 months worth of your bills. So again, when we've done that exercise of what is your essential and your protection, I would say that is your kind of amount you want to be looking at. You might want to include some of the discretionary because you might think that is essential. But, you know, if you can kind of cover 3 months worth of those essential and protection costs and have that in a cash product. So whether that's a current account, savings account, something you can get to easily should you need to. You might want more than 3 months. Everyone's risk attitude's different. So I personally like 6 months, because I'm quite a risk averse person. So I like to have more access should I need it. And everybody, again, is different, and it's what you feel comfortable with. If you have more than 3 months, 6 months, whatever you feel comfortable with in a cash product, you might want to look at what that's doing for you. So cash current savers probably 0.1 if you're lucky. With the inflation rates, there are some savings now that are higher than that. But is that going to get you to the future that you want, or is it being eroded by inflation every day? And obviously inflation's going up as well. So just again, having a check whether your savings are in the right places to get to the future that you want. So again, just talking down there's cash in your pocket, current account, savings accounts, and ISAs are probably your go-to for savings. So talking a little bit more about ISAs, has everybody heard of an ISA? Yeah, so individual savings account. So basically they are just an account and they're wrapped in a tax efficient wrapper. So everybody has £20,000 a year that they can put into an ISA. That can be a combination of a cash ISA or a stocks and shares ISA or both. And you can put that away. You've already paid tax on it because you've already earned the money, so it's your money. And then when it comes out at the other end, it's tax free. So it's tax efficient savings. So any growth that happens within an ISA comes out at the other side tax free. So these are great savings for longer term. Cash ones, obviously you can get to sometimes more readily. Sometimes they're fixed for a period of 12, 18, 24 months. Stocks and shares ones generally say that they're 5 years plus, so they're for your medium term, longer term planning. because the stock market can go up and down. As we know, there's been some pandemic and then the Russia-Ukraine conflict, so we've had some big bumps in the stock market, but the people that have it in for the longer term, it'll ride out those bumps and make a return for you. So thinking about where your money is to achieve those future goals is really important. Also with ISAs, I mentioned that there is junior ISAs as well, so you can put £9,000 a year in for child, grandchild, etc. as well, and obviously they grow tax efficiently and become the child's own savings at 18. They get access to that and they can convert it into an ISA, keep it in there, or do what they want with it. Okay, so end of the educational bit. So just consider circumstances change. Consider how your budgeting needs to change. So again, that refresh of those expenses Sue just mentioned, you know, you should change your bank accounts. Having a look at those every now and again, seeing where you're at and see where you want to be is a really good idea. Does anyone incorporate a savings figure? Do you actually put that as an expense every month and treat it seriously to get to the future that you want to have? Do you have an accessible savings pot? So do you have those 3 months or equivalent or whatever you feel comfortable with ready in cash, and then the rest of it is doing something better for you for the long term? Any questions on the educational bits before we move on? Okay, brilliant. So financial advice. So again, finance is a generally bandied around term, and not always everybody understands what financial advice does. So I thought I'd give you an overview of what generally a financial advisor does. And this is general. So some advisors specialise in only one area, but generally an advisor will look at your personal or business finance, planning objectives, and financial assets. And the things they can usually help with is pensions, investing. We talked about ISAs, units, trusts, there's other investing avenues as well. Estate planning, making sure that you don't have inheritance tax issues and there's anything around that you can do to leave a legacy as you want to. Looking at protection, so I'll come on to that next and tell you a little bit more about the options on that. And savings in general, so just helping and advise you on the best way forward to achieve your goals. So my particular way that I do that is my life process, I call it. So listening first is the most important thing. So when I call them a financial health check with the clients. I think financial reviews too a bit scary. So you should do the health check and listen to what's important to the client. So listen to those short, medium and long-term goals. And quite often people don't know they have them, but they're in there. So they have those aspirations for the future. So I draw people's life on a page and we look at all aspects, so their business, income, their property, their career, their family, lifestyle, etc. And you just get to talk about you. And then while you're doing that, I'm thinking about what you've got in place, where you're at, and fitting the jigsaw around your life. So listening. And then insight. So giving you some insight as to the options. So this is the educational part. So once I understand where you want to be, I can give you that advice to make those informed decisions. And then together form the financial life plan. So that gives you that plan to achieve those aspirations for the future. And enduring relationships. So my tagline that I'm using at the moment that someone said was really nice was financial friend for life, because actually life changes very quickly sometimes, and the whole point of advice is that it's ongoing. Because as things change, you need someone to re-advise you, again, give you those options, find out what's happening, especially with tax allowances changing and all sorts of legislation changing all the time. So having that somebody to help support you. So I'm going to touch on protection planning to start with. So protection planning is taking the time to future-proof your family's finances. It can make a real difference. So I think a lot of people strive for a certain lifestyle. So you might spend money on your property, getting it as you want to, you know, you might have spent a lot of time on your business. So making sure those assets are protected should anything happen. And there's lots of different aspects to that, but thinking about some people protect their mortgage. So they might put a life cover on there because, you know, the mortgage advisor has said it's useful to have insurance. Is that the right thing? Do you need life cover? Because that would be paid off for somebody else. Or is it more important to have critical illness cover? So should you be ill and not be able to work, your mortgage is paid off and you don't have that bill outstanding. So that is quite a lot of people do one of those covers. When you think about that is your biggest bill, absolutely. It's great to have that covered and that'll be a lump sum to pay off the mortgage. When the mortgage is paid off, do you still need to pay your council tax, your gas, your water, and all the other bills? Yeah, they're on your essential expenditure list. So actually having another policy in place that would replace your income or your essential income, should you be ill and not be able to work, is really, really important, so you can still live and get by without struggling. So just making the right choices. So again, this is the educational part, making the informed choice. You can't make a choice if you don't know what the options are. So there is life assurance. That's what I mentioned. That's the lump sums. So that could be the life, critical illness, etc. And you cover an amount for a set period of time. And it may be related to your mortgage. It may be related to some other credit card debts, loans, etc. It could be anything. It doesn't have to be linked to pay the mortgage off. So it's a lump sum for some reason. And then income protection, as we mentioned. So most insurers cover about 60 to 65% of your income. And again, up to a set period of time. Most people do it to state pension age because then another income stream kicks in. But you know, it can be varied depending on budget and what your needs are. But having that protection to pay those bills is really critical and quite often something people miss. I know, you know, you mentioned other insurances, car, home, pet insurance. You know, the pet is wonderful, part of the family, they're not going to pay your bills should you not be able to work. So actually insuring yourself sometimes is something that's missed. So income protection options, the longer you defer the policy as well, the cheaper the policy is. So if you have cash savings of those 3-6 months and you're happy to use those savings first before the income protection policy kicks in, you can defer that policy for 6 months, 12 months, whatever you feel comfortable with, and that brings down the premium of the policies. So again, they're very individual and bespoke to the person. Any questions on protection before I go on to retirement? No. Interestingly, if anyone wants to share, do you insure yourselves in some way? Most nods. Good. Yeah, great. Okay, retirement planning, another little phrase. So saving for a pension is hard, but retiring without a pension is harder. So absolutely, you know, saving for the pension sometimes feels a long way off. It sometimes feels like you don't know where that money's going or how to get it out at the other end. What difference is it going to make? And some people say when they come to me, oh, I've got, you know, various different pension pots from different employers when I work, don't know what's in them, don't know where they're invested. How can you plan for the future if you don't actually know what you have at the moment? And so gathering those, finding out what they are and doing a retirement plan where we look at when you want to retire, how much do you need in retirement? And this is where we look at that life plan and actually look at what retirement means. So is retirement the same as you're doing now? You know, the odd meals out, or is it traveling? Do you want to travel? So actually that may cost more than your essential expenditure now, but you might not have a mortgage. So it's weighing up what in retirement might cost you, what you might want to have the retirement that you want, and then looking at where we are now and trying to plug any gaps. But if we don't know where we're going and we don't know where we are, you can't do that retirement plan. And everyone's living longer. So when we're thinking about retirement, how long is that money going to last you? So we do that exercise as well. And you can see here, the top line is us females. We are living longer. The males is going up as well. But so in 2018 to 2020, the average person's living to nearly 84 years old, and that is going up all the time. So when we do the retirement planning exercise, I go on the Office for National Statistics, give you an average of how long you're going to live, and then we work back on that as to when your pension might run out. Some people might be absolutely happy living on state pension, but again, it's all personal and what do you want for your future. Just while we're talking about pensions as well, to throw in for a tip, if anybody has any gaps in state pension, please urge you to get a forecast and look at those before this tax year ends, because the government are changing how long back you can pay those gaps up. So if anybody's got any gaps, I would suggest having a little look at that before the 5th of April this year. And if anyone wants some more information, give me a shout. But just to ensure, you know, if you can, if it's possible to get that full state pension and then build on that with your own personal pension, again, if you can. So what are you allowed to put in a pension? In 2010, the government allowed us to put in 255,000 into a pension, and this year it's 40,000. So they've cut the amount that you can put into a pension as well. You can carry back 3 years. So if you haven't utilised your allowances, you can carry those forward. It is £40,000 a maximum, or 100% of your earnings. So if you're only earning 20,000, you can only put 20,000 in. And the reason why it says 4 at the end is if you're already claiming a pension, you can limit it to only be able to put £4,000 in a pension. And again, the lifetime allowance. So what can you have in your pension pot overall? In 2010, it was 1.8 million, and it's now reduced to just over £1 million. And they're not planning on putting that up in the next few years. So again, you know, if you've had corporate pensions and those are building, even though if you don't work in the corporate world anymore, those can still be growing. Sometimes, you know, actually that limit, if you've got a long time and you're planning on putting in your pension, can quite easily be hit. And you need to think about the bigger retirement planning plan, which might include ISAs and other investments, as well as the pension, just to make sure you're using those tax efficiencies. So an example of what a pension fund might be worth. So a pension fund of around 300,000, 40 years old, somebody wanting to retire at 65, assuming a 5% growth, the pension would be worth just over £1 million at 65. So you're nearly at that lifetime allowance. So again, it's just knowing where you're at so you can plan for that future. Great reasons to invest in a pension. Tax efficient growth. So again, similar to the ISA, they grow tax efficiently. How to get your money out at the other end of the pension. There's lots of options now for pension freedoms. So most people have a 25% tax-free cash at retirement. So a quarter of your pension is tax-free. You can take that as a lump sum, should you wish to, when you retire. And the rest of it is taxed at your marginal rate. So again, it's planning to use that most tax efficiently. So state pension at the moment is about 9.5 grand. The personal allowance is about 12.5. So the difference between the 9.5 and 12.5 is still at 0% tax. So you could draw down that out of your pension, top up to 0%. If that's enough to live on, you're not paying any tax on it. If you draw any more down, it would go into the 20% tax bracket. But most people are already given the 20% tax relief when they put money into a pension as well. So it's, again, just balancing out what's right for you and trying to get it down in the most tax efficient way. There's also children's pensions. So again, like children's ISAs, so every person, whether they're working or not, including children, have an annual allowance of £3,600. This includes the tax relief from the government. So there's no automatic 20% tax relief. So you only need to input £2,880 and it becomes £3,600 and then gets invested. Obviously, they can't access it up to 55, same as pension now, which may be going up as well. But who knows if a state pension will be around when our children or grandchildren grow up. So actually thinking about those things, you can also combine that with inheritance tax and gifting. So you're reducing your estate and putting it in something worthwhile for a child's future. So again, just other things to have a little think about. So that's it. We've rattled through that quite quick. I think I'm early, Sue. So I do have a wealth personality tool, which takes about 5 minutes to complete. Again, I can send the link afterwards, but just gives you a little bit of insight as to what you think about finance and where your mindset's at, and things like, is ethical investing important? So we talked about, do you know where your pensions are from corporate world or previous jobs, or your investments, ISAs? Do you know what they're invested in? Is it where you'd want your money to be invested in? Is that important? So it just kind of goes through some of those things and gets you thinking about what your goals are. So anyone's free to do that and free to share it with anyone that you want to. You get a report back that talks you through it. And then financial health checks. I mentioned before, my approach is that life approach, draw your life on a page. It's very relaxed. We just talk about you. You don't need to know about your finances. So if anyone would like one, they are complimentary. They take about an hour and a half, and we explore your short, medium and long-term goals and try and get you to that future that you want. Thank you very much.
Thank you, Tina. We've got about 10 minutes for questions, so please do. Shall we take the screen away so we can sit? That's it. Brilliant. So, oh, we've lost someone on the way. One thing that you just picked up on there, Tina, that you shared with us is about where your pensions are invested. And I think that's been in the news, hasn't it, quite recently, that some of our pensions, if we have one, are in countries and things that perhaps we wouldn't want them to be. Can you share anything else on that? Do you have any more information on that? Because I think that's quite interesting.
Yeah. I mean, it is sometimes quite difficult to find out from the pension companies where they're invested. I have something called a letter of authority that people can just sign. It gives me authority to gather the data. Once I have it, I can plug all that into something called FE Analytics, and I can analyze all the shares and the things that it's invested in, so we can have a look at that and see whether, as well as where it's invested, what attitude to risk it's in. So actually, some people say to me, oh, I'm really risk averse, I'm in low medium. And when I look at where they're invested, they're in the upper medium. So actually it doesn't sit with the comfort zone at all. So there's lots to explore and have a look at. And, you know, I have clients that I do bespoke portfolios for who want to take out things like arms and defence, forestry, tobacco, you know, industries that they wouldn't necessarily want to associate themselves with. But again, it's the educational piece. You don't know what you're in. You can't make a difference and change that.
Thank you for sharing that. Right, ladies, please think of your questions, because I am now going to say thank you to Tina as we're going to end our recording for our replay, because if we've got some questions we want to ask, which we don't want to broadcast to the whole world, you will only have the small group here now to ask away and Tina be able to answer for you. So thank you for watching on replay, everybody.
Thank you.